Just a sec. Uh-oh.
Got it.
Oh, I have to say got it. Okay. All right. Here we go here. So yes, how to demystify. Where's our title on here? I don't even see it. I forgot exactly the wording of it, but how to you read off the headline. Oh, there it is. How to demystify the headlines and create monthly payment affordability. Yes, that on the left-hand side is Alexa and Leah's on the right, and I'm in the center there. I've been working with Jason and Joe for, well, Joe a little bit longer, but probably the better part of the last 10 years or so. And we've closed a lot of transactions successfully together. And yeah, and I've been working with, our team has been working with the Madrona group as well, most recently. So yeah, you want to skip to the next one, Liam? And for anybody that doesn't know, so Priority Home Lending, we work inside of, I usually, not all the time, but I usually sit in the Linwood John L. Scott office. Priority has a relationship with John L. Scott where we have an affiliated business arrangement. John L. Scott is part owners of Priority Home Lending. Our parent company on the mortgage side is Cornerstone Home Lending. And so, I don't know, way back about 10 years ago, John L. Scott Lennox interviewed probably about 10 different mortgage companies to decide who they wanted to work with to have in their offices, have a hyper local, high touch mortgage presence in the office. And so there's probably about 14 or 15 of us Priority Home Lending loan officers throughout Washington, Oregon, and Idaho that work in the corporate run John L. Scott offices. So, and I've been with the company since the inception, since 2013. I think June 1st of 13 is when it officially became a company, Priority Home Lending. So yeah, I've personally been doing this about 20, I'm in my 21st year now. So, yes. Oh wait, go back to that, Leah. I just wanted to see if there's anything else. I think some of you guys know, I think we pulled some of this off of the website. You know about John L. Scott, but Cornerstone was founded in 1988, based in Houston, Texas. They're one of the bigger non-brick and mortar banks in the US for as far as mortgage lending goes. I shouldn't say bank, mortgage bank. Yeah, and let's go to the next one now. Okay, let's just start off with these headlines that we're seeing here. Yeah, we got half of these, Leah put together these headlines that she just pulled off the internet here. Half of Seattle homes failed to sell for initial asking price in July. Seattle home area prices trend down. See what's happening. Seattle area home prices log first monthly decline since 2019. Seattle has fastest cooling housing market. And that, by the way, there's an article that Redfin put out, the fastest cooling housing market in the whole United States. Seattle home sellers aren't getting 100% of their asking price. So we're getting a lot of negative news about our housing market. And I guess my question for you guys is like, how are you guys, combating that? What are you guys saying? If I'm a buyer and I come up to you and I say, I don't know, like everything that I'm seeing is negative. I should wait. Bob at work says that I shouldn't buy, that I should wait longer. My uncle that used to be in real estate says to wait longer. I don't need to buy. There's going to be a crash. Does anybody have anything that they could add, like as far as, like Jason, let's just start with you. What are you saying to somebody when they come to you and they seem to have kind of a negative outlook on buying a house right now, but they obviously, if they're talking to you, they're thinking about buying, but they also have, fears and definitely some qualms about purchasing right now.
Yeah. Well, there's always a couple of things that I lean on. One of the things, obviously, you're going to validate the fears, right? The fears are real. The headlines are real. The feelings are real. And so, we like to validate and yeah, I'm right there with them, right? Yeah, I see it all, and that it even freaks me out sometimes until I stop and actually look at the numbers, and then so I just like to make sure that I'm always armed with the facts. And the facts are that yes, like one of your headlines said, it's like home sales have like stopped going up for the first time since 2019. Well, yeah, absolutely they have. And that's actually a good thing, because if they would have kept going at that rate, nobody would have been able to afford a house where it's already pretty expensive as it is, right? And the reality is that we had this very abnormal 2 years due to the fact that the government was giving away free money. And so people were taking advantage of that. And now we're back to, the interest rates are definitely not where we want them to be. But historically, they're still pretty good. And of course, Dave's going to teach us how to throw some creative financing ideas at them and see if maybe that can't help.
And a couple of the talking points that we're focusing on too is, what it was like when it was hot. Everyone was frustrated because they couldn't get a house. Now all of a sudden we have availability, we have pricing, we have terms and selection. We didn't have that. So a cooler market means you're going to get some better terms, some more availability, and you're going to get better pricing on it. So those are also some talking points to debunk this. Like, talk about what the hot market was. What did that look like? Everybody was burnt out, frustrated.
Does anybody else have anything to add, like how you guys are handling the objections? Well, I want to call names, but I don't know. I was going to say I'm seeing Jen Shaughnessy. How are you handling these objections?
Hi there.
Hi there.
So I have a jackhammering project going on in our house. So if you hear a rumble behind me, some landscaping outside. Okay. I'm crouched in the quietest corner of the house right now.
We're glad you could join us.
But, it's true that we do need to validate their fears, and the fears are valid, but putting a spin on it sometimes to really play up the positives and the creative financing options, but really for buyers that weren't able to compete in the past market. Maybe they were only 5% down. They were not competing with the 20% down buyers. They were booted out of the market. So there's opportunity for them now. Also, I can recall a number of sellers that I had last year that were intimidated to jump. They wanted to sell and buy at the same time, and they weren't successful on the buy side. So they weren't going to list until they knew there was going to be something to buy. So this is an opportunity for those folks as well to be able to buy something. And the whole, marry the house and date the rate. That's so true. The rate over a 30-year time frame or less of somebody owning a home, rates are going to go up and down, and there are refinancing options. So I think it's just kind of educating them on the options is what our job needs to be right now.
Yeah. No, I agree with everything that you said there. I mean, we had people that we worked with that were first-time home buyers. They had their little family they were starting, and they try to put an offer on a house, and there's over 30 offers on that house, and half of them were investors. And it was like you felt bad for them. I mean, you really felt like, wow, how are these guys going to get into this market? And I have agents that I work with that have kids, or I know people that are trying to get in the market, or they have kids that are trying to get in the market, and they were like, I don't know if I'm ever going to be able to buy a house. And that was only maybe 6 months ago. They were saying that, maybe 8 months ago. And wow, like, you can buy a house again. Like, you thought your dreams were, crushed. You could never, you missed the boat. It's like, no, you're back in. So I think that, there's another side of the coin. And that is that it's created opportunities that people really didn't have 7 or 8, 9 months ago. So yes, the rates are higher, but there's opportunity to get into a house and we have ways that we can make it affordable for them with seller credits, doing permanent buy downs, temporary buy downs, just making it affordable for them. And then they can hopefully in the coming, not too distant future, be able to do something with that loan and get the payments lower.
Yeah,
So,
and I
yeah.
think that's one of the big talking points too, Chris, that we've been Dave, that we've been having. I'm looking at Chris's picture for some reason. The payment, right? And this was a video that I shared at a sales meeting a couple of weeks ago, but it's not an original idea, where you take, a house that was maybe $1 million 6 months ago, and now that same house is, probably 800,000. And you take the interest rate of maybe it was 4.25 versus, whatever, it's 6.5 or if we can get it down a little bit, and the monthly payments don't really, they're very similar. Right. And so if the end result is the same, but, oh, by the way, you actually got to spend longer than 15 minutes in the house before making a decision on it. You didn't have to waive everything. You got to do an inspection, so you know exactly what you're into. You didn't have to waive your appraisal. Option B is actually better, so it's just perspective.
Well, think about this. What if you went to a car dealership and you could pay $80,000 for a vehicle and get a lower interest rate on it? Or you could get a vehicle for $60,000 and pay the same exact vehicle and pay a higher interest rate on it. You'd probably say, I'll figure this out, but I want the cheaper car. I don't want to pay $80,000 for the same exact car that I could pay $60,000 for. It's like you would rather maybe I have to pay a little bit higher payment than I would have paid when the rates were lower, but I'll take the 25-30% discount, and hopefully have an opportunity to get my payments lower in the future, or refinance the loan, which I think that's how I would think about it. If it was a lot of things, whether it be a car or whatever it is, you're getting the value right now. So yes, we view this as, I'm back to the slides. We view this as the time buyers have been waiting for. Our job is to show them the numbers to help them attain their goals. We got creating affordability is one of the biggest hurdles. Sellers expect higher sales prices, and buyers are struggling with monthly payment affordability and fears where the market's heading. We got the graphic, like Jen just said, which I feel like it's almost cringeworthy now for me to say, but marry the house and date the rate. Which that's what it is. Get that house that you want right now. Get the inspection. Buyers can be picky right now. They can get what they want. Before I felt like you couldn't be picky at all, really. And if you were picky and you had really good taste and you wanted everything to the nines or whatever, you were going to have to get into like an emotional type of bidding war where you were doing irrational things to get the house. So and that leads into, I wanted to talk about seller concessions. We'll get you guys, can I share my screen, Jason? Because I just want to show a graphic that's a little bit bigger than this one here. Can I just hit share screen? That'll work for me?
Should be able to, yeah.
Okay. Let's see here. Okay, this is a flyer, and we have lots of flyers we can give you guys. Do you guys see this one, maximum seller contribution limits? You don't?
For some reason, we're still seeing, oh, here we go. Yep.
Okay. So this is a flyer that we can get you guys. That's a nice little cheat sheet to be able to look at, so when you are negotiating, or if you're on the listing side, buyer side or listing side, you just know kind of what the limits are, what can be done. So for conventional primary and second homes with less than 10% down, the seller can contribute up to 3% towards the buyer's closing costs. So if that's a smaller price point, say it was a condominium, maybe $200,000-300,000, it's not going to be a huge number that you can contribute. If it was a $300,000 condo, that's only $9,000. But if they were putting down over 10% down payment, up to 25%, you can contribute up to 6%. So say that was a $700,000 house, That's going to be up to $42,000 if they put at least a little over 10% down, or in anything over 10.01%, they can get 6% from the seller, and that can go towards it can go towards closing costs and prepaid expenses. Just to make sure anybody that doesn't know, a seller can never contribute towards the down payment for the buyer. It can only go towards closing costs and prepaid expenses. But yeah, 6%, that can really give somebody some money to play with to be able to really make the payment affordable. Over 25% down, 9%. So if this was that $700,000 house, that's $63,000 credit the seller could give towards the buyer's closing costs. Excuse me. Conventional investment home purchase. So if this is an investment purchase, the seller can only contribute 2%, regardless of the loan to value, whether they put down 10% or 50%. It's only 2% if it's an investment purchase. FHA purchase, 6%. Seller can do 6% on FHA. VA is 4%. And USDA, which we don't do these as much anymore. I do them a little bit more up here in Linwood, but I wouldn't think down there in West Seattle or Ballard that you guys get to do too many USDAs, but that's 6% on USDA. If anybody's interested on USDA, it's probably the best zero down loan there is outside of the VA loan. And we can send you guys a link to the USDA eligibility map. If anybody wants that, we can get that out to you guys. I'm going to stop share and go back so we can do the slideshow thing. Okay, I just wanted to show a bigger graphic. That's what that is. Oh, could have done that too. But this is the graphic on that we had. So let's go to the next one, Liam. Okay, permanent buy down versus a temporary buy down in a 30-year fixed loan. What is a point in a permanent buy down? So 1 point, what that means is 1%. If it's 1 point, it's 1% of the loan amount. So when you hear the term 1 point, just think 1%. If they say half a point, that means half of 1%. Below here, can we zoom that just a little bit more, Leah? Yeah, the pricing grid there. Okay, this is a pricing grid that we pulled up. This is what I see on my side when somebody says, hey, what's your rate today? Or what kind of rate do I get? Well, I have a whole grid here. It goes down into the 5s, and goes up to probably, this is zoomed in, but I'm sure it goes into the 8s. And each rate has a cost associated with it. So these, in this middle column here, what you're looking at are the points. So today's pricing got a little bit worse again, unfortunately. 7.125 interest rate is 1.125 points that the borrower would have to pay to get that interest rate. If they wanted to pay, say, 2.375 points, or it's 6.75% interest rate, and so on. But this is what we see. This is all lenders. We don't just get an email in the morning that says, this is what the rates are, this is what you tell people. It just depends. And this pricing grid off to the left there, this pricing grid is really dependent on, like, what numbers I see is dependent on how much money they're putting down, the property type, their credit score is probably the number one thing, obviously. Those are the big things. And then the occupancy, whether or not it's an owner occupied or if it's an investment property. So there's a lot of variables that decide interest rate. Yeah. Does anybody have any questions on anything? That I don't want to get going too far and putting people to sleep and people have questions. Anybody got anything? No? Okay. Off to the right here. Oh, yeah. This is an example of a flyer that, and I actually have that one too. I could blow up, but this is an example of a permanent buy down. on a $750,000 sales price, this is a flyer that we can put together for you guys if you have a listing or if you want to present this to a seller and show them what can be done with a seller credit. So $750,000 sales price. This is a 20% down payment. And so the loan amount, 600,000. Now, if they pay 0.375 points, you have the scenario 3 on the far right-hand side. That would cost $2,250 in points, and the interest rate would be 6.125. This is not current, by the way. This was prepared, it looks like, on August 19th. So this is not, just want to make sure we know that's not what the rates are at the moment. Just wanted to show you the example of what can be done with points. Okay, scenario 2, we got 1.125 points. That brings your interest rate down to 5.625%. You can see that lowers the monthly payment by about a couple $100 a month. And so you're spending, if you look in that points cost line there, you can see they're spending about $4,500 more to save about close to $200 a month. That's a pretty good break even right there. So that's something that would definitely make sense for most any buyer, unless they said they were flipping the house or something. Then scenario 1 there, that first column we have, that has 2.25 points and is buying the rate down to 5.125. That on this loan size, that costs $13,500. That's 2.25% of 600,000. And so that one brings that monthly payment down to $3,267, that bottom row there. So this is just an example of what can be done on a permanent rate buy down with a seller credit. And that's really not that expensive. When you look at $13,000 on a $750,000 price point, I think that's pretty reasonable to ask a seller for a credit like that. And you can see the difference between if you didn't ask for the credit and you did ask for the credit. You're talking about almost $400 difference in monthly payment in that example. And just to for perspective, to drop a payment $400 by dropping the sales price, with today's rates, you're probably talking about dropping the price at least $75,000 to do that, to drop a payment by $400 a month. So this way, it's a win-win. The seller is only paying, say, $13,500 versus dropping the price by $75,000. And so the buyer's getting their payment and the seller's netting more money. So that's why these credits are so big right now, and we're all talking about them, is because it's just a win-win for everybody. Okay, let's go to the next one. This is another example of a this is actually a 2-1 buy down that we did. So, okay, I'm going to read this on the right first. So what is a temporary buy down, and why do we think this is a smart investment? Temporary buy down funds are not lost if refinanced in the future. Unlike permanent buy down, loan is fixed for 30 years. So let me give you, we'll just go to this one on the left-hand side that we made a flyer. This is a listing in Seattle we did for another agent. We made him a flyer. So the price on that house was $699 something, is basically $700,000. And so we made an example to show a prospective buyer what could be done with a 2-1 buy down with a 20% down payment. The note rate, so this temporary buy down, the note rate on this loan is 6.75%. It's a 30-year fixed mortgage. It's fixed for 30 years at 6.75. It can never change. It's the most conservative loan that's offered. Okay, the temporary buy down, what that is you can pay a fee up front, which we're having the seller pay for this fee up front, that buys down the interest rate temporarily in years 1 and 2. This particular example is a 2-1 buy down. The 2 part of that 2-1 buy down is year 1, you pay 2% below the note rate. So you'd pay 4.75% in year 1. In year 2, you pay 1% below the note rate. That's the 1 part of the 2-1 buy down. So in year 2, you get to pay, in this example, 5.75%. And then in years 3 through 30, you'd pay that note rate of 6.75. Now the note rate, this whole loan has been 6.75. But what happens on a temporary buy down is that money is collected up front and it goes into this separate holding account, that money that you're paying to do this temporary buy down. And you can see we have in this graphic here, it says point cost, $8,518. That is the temporary buy down for year one that you're paying up front. And then in year two, you got $4,363. So total, this is almost a $13,000 cost up front to do this temporary buy down. I'm not quite sure that column 3, Leah, what that number is there.
That's a permanent buy down.
Okay, so the reason there's a number in there is for years 3 through 30 is because that money was spent to get the initial 6.75 note rate. But in years 1 and 2, you're paying essentially about $13,000, and you can see the monthly payments here. So if we never did a temporary buy down, you look at that years 3 through 30 monthly payment, that's $3,626. So if we didn't do anything, that's their principal and interest payment on this $559,200 loan. But because we did the temporary buy down, they get to have a principal and interest payment of $2,917 in year one. So that's a $709, almost $710 monthly savings, which really will help somebody. When you look at you're paying about $13,000 to do this, and you think about what $13,000 would do if you just lowered the price by the sales price by that much, that might save them about, I'm going to say about $70 a month, $75 a month. But with this temporary buy down, it's saving them $709 a month. That makes a difference. That's like, okay, that might get me off the fence to buy this house. In year two, with that 1% difference, it's saving $363 a month versus what you would pay if it was just the regular principal and interest payment on the 675. So in the biggest beauty part of this whole temporary buy down, in my opinion, is the fact that if somebody, let's say next year, interest rates come down, interest rates are in the 4s. Looks like we have a little segue thing in the bottom that I want to talk about. Fannie Mae forecasts that interest rates will be in the 4s next year. That's an article. It's a CNBC article. We can send you the link to it. Basically, the gist of it is they say that once we start getting this inflation under control, long-term money, long-term rates should start coming back down. And so that's what they forecast. So people might say, well, why would I want to pay all this money up front right now if we know that I might not even have this loan even a year? Why would I spend all this money up front? Or this seller credit to why would I use a seller credit to do all this? Well, the beauty of this temporary buy down, we have it written up here. Temporary buy down funds are not lost if refinanced in the future. So like a permanent buy down, that money's gone. If you buy the interest rate down permanently and you refinance that loan in 6 months or a year, you may have, lost some money there because you probably paid for something that had a break even, at least probably, I'm going to say 3, 4, 5 years out when you're buying the interest rate down on a permanent rate buy down. Those break evens usually are at least 3, 4, 5 years down the road. So permanent buy down right now, if we're forecasting, or they are forecasting mortgage rates to come down, or a permanent rate buy down, I mean, nobody has a crystal ball, but it might not, you're kind of gambling a little bit by spending a bunch of money buying your rate down permanently if there's a good chance you'll be able to refinance in the next year or so. So with a temporary buy down though, that money that you spend up front, that $8,500 and the $4,300 with about $13,000 that we have on that flyer there, that $13,000 sits in a holding account. And each month you have your regular payment at 6.75. They pull money from that holding account. It's really like an escrow account. It sits there right next to your taxes and your insurance and your escrow account. They pull money from that account and subsidize the mortgage payment and make it so you save that $709 a month in year one and save that $363. But what they're doing is they're taking that $709 a month and pulling it from that account and helping make your mortgage payment each month. So it's not like that money that you spent there, it's not like it was, it's exactly dollar for dollar. It's the same amount of interest that you're saving is what in the first 2 years is sitting in that holding account. But the beauty part of this is if you were to refinance this in a year, that money that's sitting in that account, that will be netted out of your payoff, or they'll write you a check for any money that's left that you didn't use of that buy down. So you can never lose on that. You're never going to have spent all this money and then you refinance it. You're like, why did I do that? I just refinanced the loan. You'll get that money back. So you're either going to use it if the rates don't come down, and if the rates do come down, you can refinance that loan and you get that money back. So that's the beauty of the temporary buy down, in my opinion, because you can't really lose. You're going to get that lower payment, and you're not going to ever lose any money because you didn't hit your break even point. Anybody have any questions on that piece? Because that's pretty big. That's a big one that I've had agents say, well, why would you spend all this money up front right now if you think interest rates are going to go down? Well, the first thing is we don't know 100% if that's going to happen. And even if they do, we're protected. That money that we spent on that temporary buy down, or the seller credit paid for in the temporary buy down, is just sitting there, and it's your money. It's the borrower's money. So if the home is sold or the home is refinanced, the loan is refinanced, you're going to get anything that you haven't used back. So anyways, that's huge. Okay, so yeah, we have Fannie Mae forecasting that the rates are going to come down. Yeah, and we'll get you guys some links for that if you want. I think that's a great tool to have in your arsenal when you do have someone that is, really, asking you, well, do you think it's a good idea? What's going to happen with rates? Then you have something that's legitimate from a reputable source, like a Fannie Mae. It's not coming from you, it's coming from Fannie Mae. So, I think that's we have some good material to present to them if they are, questioning what's going to happen. It's like, well, interest rates are slated to go down, and home prices have already come down 25-30%. So it really does go back to the marry the house and date the rate. Okay, what's the next one, Leah? Oh, closing cost guide. So do we have a cost analysis worksheet too, Leah, that we can show them? Wanted to just show you guys what makes up closing costs. Just without paying any points, temporary buy down stuff, you have appraisal fees, credit report fees, lender's title insurance policy. The buyer gets to pay half of the escrow charge that the escrow company charges. There's a recording fee with the county. Sometimes there's document prep fees, like if somebody's doing a quick claim, or sometimes there's like power of attorney type stuff. There's a few different examples where they'll charge for stuff like that. They're going to have to pay a year's worth of homeowners insurance right up front. That'll go into their escrow account. There's going to be some prorated property taxes. They, potentially, they may get a home warranty. If there's flood insurance required, they could be paying a year's worth of flood insurance up front. They wouldn't see it on our estimate, but if they do an inspection, they'll have the inspection fee, survey, pest inspection, HOA fees. If they're buying a condo or if they're buying a planned unit development home, they're likely going to have some upfront homeowners association fees that'll go into the reserve account and potentially pay either their first month or two of HOA dues, or even, like on a PUD, sometimes you'll just pay through the end of the year the HOA fees that are due. Yeah, and then as far as lender fees go, that at the top there, they don't have to, they could have origination fees. There'll be some prorated interest through the end of the month that they close in. So if they close, let's say on November 15th, their first payment's not going to be due until January 1st. And the reason there's no payment due on December 1st is because we'll collect interest from the 15th of November through the 30th, right up front at closing. And so, because when you make a payment on the first of the month, you're paying for all the interest that accrued the month before plus some principal. Well, on December 1st, you would have only had the house for about 15 days. So rather than collecting a partial mortgage payment, we collect that interest right up front. And so that's why that's why people get to skip that payment. And then there could be some private mortgage insurance, or you've probably heard it called PMI. And then we don't need to get too much into the seller fees, but there are seller fees. Homeowners title policy, half of escrow fee, excise tax, real estate agents or brokers commission, outstanding utility bills, loan balances, HOA fees, assessments. Okay. Oh, so we do have a cost analysis worksheet. Okay.
Yeah, you have those pulled up, Dave, in your PDFs.
Oh, in my PDFs.
Yep. So you just have to share your screen.
Okay, hang on just a sec here. I don't know where
Well, I have a buy down.
share your screen. I don't see it. Yeah, I'm looking for a cost analysis worksheet. If we don't have one, that's okay. We can keep moving along. But I was going to show you guys a cost analysis worksheet that we show people. It's a breakdown of what I just talked about, the closing costs, the prepaid expenses. Can you go back to the slides, Leah? Okay, that's a closing disclosure. Oh, so okay, so we actually that is it. Okay, so does anybody have, while we're pulling this up, does anybody have any questions on anything that we brought up so far? Temporary buy down questions? Terry, you get the permanent buy down stuff?
That's great
A
information.
lot better than I did before, yes.
Anybody else?
This is great information. I haven't heard it explained in this detail. So thank you.
Yeah, for sure. Was that Jen?
Yes.
Thanks, Jen.
He's a better lender than he is a Zoomer.
Yeah.
Come on, guys, don't discourage him.
So
Great.
Where's the PDF?
yeah. So this is what Leah just pulled up as a presentation. This is actually somebody that I work with Chris on, Chris Fiamingo, who's on this call, if anybody doesn't know. But anyways, this is what we show clients when we start trying to help them decide what makes the most sense for them. We have a tool called Mortgage Coach. We present them with a total cost analysis. And this is an interactive tool. So if they're on the other end looking at this, I can highlight things and they'll be able to see what I'm highlighting on their side. They'll be able to click through and look at closing costs, a breakdown of payment. They can look at break evens, how long it takes to get your money back if you spend more money to buy your rate down. So this one was for Viv and Vicky, and you can see we showed them 3 different examples. The sales price for them was 7.25. And they were putting a good sized down payment down. They were putting down $330,000. And so you can see we have the interest rate of 5.49%, then 5.875%, and then 6.125%. In those three columns, strategy A is 5.49, B 5.875, C is 6 1/8. And you can see if you look at those in the middle there where she has the cursor, you can see in green there. Strategy A saves them $159.77 versus strategy C. If they were to take 6 1/8 versus if they were to take 5.49 versus 6 1/8, it saves them about $159 a month. And then we show them the cash to close. You can see the cash to close on strategy A. It's about $7,400 more to save that $159 a month. And so we go through it with them and see, okay, well, we can get you the pretty rate. Does it make sense for you to pay the $7,000 extra up front how long do you plan on being in this place? The break even might be 4 years down the road. Does this make good sense for you, and what your plans are? So we go through this with everybody before we decide, when we're locking an interest rate in, what makes best sense for them. Yeah, and then there's some a tab where we get into a breakdown of how their monthly payment works. And then we go into closing costs. And there's some other tools beyond the payment breakdown and the closing costs. I don't get too much into the reinvestment tool, but you can really start analyzing these numbers. And I just don't like to get people too lost in the minutia stuff. But it's usually just about, how much do I have to pay, and what is my payment going to be, and what is the break even? Does this make sense for me? So those are usually the numbers that we're focusing on when we go through this. But it is a pretty cool tool. They get this link sent to them, and they can pull it up whenever they want throughout the life of the processing of the loan. And sometimes we'll do these just to give people an idea of what they're looking at before we even get to pre-approving them or get into contract. And what we'll do is, maybe 2 weeks go by and they haven't found anything, we'll simply update this with the rates. Or if they find a specific place, we'll update the sales price and use the current rates. And it's really quick and easy for us to do this. And they can use that same link and look and see what the numbers are, and they can look at it whenever they want. They have that link. So that's a tool we use. Why don't we share this, the buy down agreement, so I can just show people, Leah, what the buy down agreement looks. So this is a person that we did. Can you zoom it just a little too, Leah? This is one we did for a guy. It was a very cheap temporary buy down. Maybe give it another couple shots, Leah. It's a little, yeah. So this is the buy down agreement that he received in his disclosures. This one was a 1.0 buy down. So the note rate on his loan was 5.625%. Year one, he got to pay 4.625%. This only costs him $4,100. Now this buy down it's going to change depending on what the loan size is. This guy's loan was $556,700. And so he got to have a 1% lower interest rate, which saved him $342 a month in year one. It only costs $4,100 to do that. And if you could get a seller credit, for $5,000, we could use that, to do something like this, and then use the rest. Any excess we had left over could go towards their closing costs. But you can see that's a pretty cool way. $4,000. I mean, to save $342 a month, if you were to lower a sales price, I mean, you're lowering it probably at least $60,000 to save $340 a month using today's rates, where this only costs $4,000. So, but this is the buy down agreement. So you can see, if you look to the far right, the principal and interest payment is what it is. It's $3,204. But what the borrower's portion of that is in year one is only $2,862. So it is a fixed loan. It's basically a little trick how I look at a temporary buy down is it allows a buyer to graduate into their payments and ease into them. Most people, I think, expect to be making more money 2, 3, 4 years down the road. And so this allows them to get the house that they want, have a payment, especially in this market with these higher rates. They can get in, they can be picky, and they can get that house that they want, and they can even get a payment that actually sounds pretty good to them, even though the interest rates are pretty high. And with any luck, they'll be able to refinance that too. So yeah, that's what the buy down agreement looks like. What other fun stuff do you have in there? Let me see if I got some.
Dave, is it the permanent buy down then, that also, because it's actually buying the rate down permanently, that would then also lower the debt to income ratio?
Okay, so so sometimes we end up doing a permanent rate buy down. I'm saying that in the wrong order, I think. Sometimes we'll buy the rate down permanently rather than doing a temporary buy down. even though maybe the temporary buy down would make more sense. And the reason that we do that is on a permanent rate buy down, I can qualify them with the note rate after we bought it down. This temporary buy down, I'm still qualifying them at the higher note rate. And so if they're spending all their money to do the temporary buy down, maybe that doesn't help them qualify for the house because I still have to qualify them with the note rate. So on these temporary buy downs, we're still using whatever the note rate is to qualify them. Even if we do a 2-1 buy down and in year one, their rate was 3 point something percent. I have to use the note rate of 5 point something percent for qualifying purposes.
And
So
that's a great thing, right? Because like I know a lot of people, like even when I posted this, a few people were like, oh great, you know, creative financing, this is the beginning of, you know, 2008 all over again. But see, here's the difference. You're still being qualified for that 30-year fixed note rate, right? So that means you can still afford that. You're just getting a little bump for the first couple of years to help out in, you know, we're hoping that we can refinance after a year or two, but you can also currently afford it if you can't, which is a huge difference. I think knowing that's important.
Yep. There's, I mean, it's you're getting those nice payments, but you still really do have to qualify, which pre-2008, you didn't really have to qualify to buy a house. You could make $500,000 a year running a hot dog cart if you wanted. So what else do we got? You like that one, Joe? Oh, I got another one that I can.
It's great. I love this stuff when we can figure out ways to get there, you know, and like that's I don't think that can be stated enough. Like that changes the debt to income when you buy it down. So sometimes that is a strategy. So there's a lot of moving parts to this financing, and that's why it's good to look at it several different ways.
There's other things that sometimes. Oh, sorry, Joe. No, I was going to say there's other things like that we can do with seller credits. Like sometimes if they're putting less than 20% down, we'll buy out the monthly mortgage insurance so they don't have any monthly mortgage insurance. They could be putting a 3% down payment down on a conventional loan and not have any monthly mortgage insurance. So, and we can use that seller credit to pay for that. So there's a lot of creative things that can be done to help create affordability. We have lots of flyers for you guys. If anybody wants any flyers that you think, you know, even if we haven't even talked about one, if you have an idea for a flyer, you want a digital flyer for your Facebook or any marketing stuff that you want that talks about creative financing, that's what we're here for. So we've got a lot of stuff available to us. We've created a lot of stuff already, open house flyers, you name it. We've got lots of stuff that I think could help maybe get your potential buyers off of the fence, or even make the ones that are, you know, make people feel better about, you know, what they're doing.
Hey, Dave.
You know, and still a little confidence. Yeah.
On that note, I know you guys have been sending stuff out already, but yeah, I mean, maybe just like a flyer starter kit, you know, like send it, like maybe send the team, like, you know, I guess like, you know, a group of flyers that.
What's that? The last part you said?
Just send out the team like 3 or 4 flyers that would be particularly useful in that way that you were just talking about.
Yeah. I mean, we have definitely just some we have flyers that are not specific to a property address or a sales price, or, you know, we have a lot of stuff that we've created that, you know, we can fill in your, you know, whatever the price is on the home. This is more, I guess, if you have a listing, or if you're doing a listing presentation or whatever. We've created a lot of stuff that's, you know, we can fill in. But we also have stuff too that we can just give you that's a little bit more generic, or not too specific, but talks about, you know, things that can be done. What is a temporary buy down type of stuff?
Yeah, and that's what I'm talking about, like something to share with. Well, I'm thinking about buyers, but yeah, stuff to like share with buyers. Like when you're talking to them about this stuff, it's like, okay, here, look at this. Like this is what I'm talking about here.
And I think that I've said this before in another meeting, but if you guys are working with somebody and they have a pre-approval letter from ABC lender, that pre-approval doesn't mean that much as far as if they say that they can buy a $750,000 house, they're probably not qualifying them with a big seller credit. That same buyer may be able to buy an $820,000 house if you can get a credit. So if you got a letter that says 750 and you find a house that's been sitting there for 52 days or something, and it's let's say it's 800,000, there's probably a good chance that your $750,000 buyer can buy the $800,000 house. So don't, stay open-minded. In this market right now, you can do a lot of fun stuff to get people qualified for higher price points. So.
And also, I know your one of your sheets touched on it, but I know with one of my clients, we can do a combination. So we actually did the permanent buy down and the temporary buy down.
Yeah.
And so, you can just stack this stuff up too. I mean, if you can get that much in seller credits, right? Which is really, it's pretty amazing. What you can do, the opportunity of this particular buyer just didn't have this 6 months ago, right?
Mhm.
Like we checked all the boxes of all of their needs. We missed a few of their wants, so that's okay. We checked all the boxes of all their needs that just couldn't have happened 6 months ago. So pretty phenomenal.
Yeah. And their payments, it's probably just as good as it would have been back when the rates were half of what they are today. So
Yeah.
because they're getting the home for cheaper, and we did some creative stuff to get the rate lower.
Yeah.
And not every agent in the industry is taking the time to get informed on this stuff. And so we might have to take the lead when we're submitting an offer and letting the agent know, hey, to accomplish this, we'd have to lower we would be asking for a 725 price on this. Instead, we're asking for $15,000 in closing costs. We're trying to get to that payment, so a lot of agents may not understand what you're doing. And so if you explain that to them, it might go a lot further.
Yeah, and knowing how to explain it like in this great detail, like Jen talked about, Dave, and thank you. I think you do a pretty good job of making things pretty simple to understand. But knowing how to explain it so that because right off the bat, man, and even when I presented it to my client initially, it was like, this is an ARM, and I'm going to get this huge payment at the end that I can't afford, and I'm going to lose my house, right? Isn't that everybody's fear? So knowing how to explain it and show the differences, I think is super critical.
Mm-hmm. Yep. The temporary buy down it's perfect, I think, for this market right now, so that we're in. But yeah,
Great stuff. Thank you so much, guys, for bringing this to us.
Yeah, for sure. And thanks for everybody that attended. And if anybody wants to hit us up for any specific flyers, if you have a listing or if you have any questions on this, I mean, we're here, we're prepared. We will definitely put together some flyers like Terry asked for, just that the starter pack, the creative financing starter pack. So
Creative financing for dummies.
Yeah, and I'd love to hear victories you guys have when you're using this stuff. Let me know how you're utilizing it, and let's start talking about that. We all lift each other up. So
the one that I showed you guys where it was the guy with the 110 buy down, he had this number where I showed you the buy down agreement. I could pull it up again, but that one, he was not ready to pull the trigger on the house. He had this payment in mind where he wanted his full payment to be around $3,500 a month. And he wasn't going to do it. And so the agent's like, well, do you have anything that you can do? I was like, heck yeah. And so it only cost $4,000. And that's all it took for him to decide, I want to buy this house now. It was as simple as that. $4,000, and he bought the house, and he wasn't going to. So because of that payment, and his thing was, he knows that he's going to be making more money in a year or two. And so it didn't bother him that payment is not permanent, but it helped him pull the trigger so he can sleep at night and have a payment that he's not freaking out about.
Right on. All right, guys. Thank you.
Thank you,
Thank
guys.
you.
Thank you very
Thank you,
much.
guys.